Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, so we did see US equities close lower after an initial spike post CPI, as inflation data did come in a little bit softer and show some signs of deceleration in that Fed's key measure of core services ex shelter. But then we also got data from the FOMC minutes talking about Fed officials really noticing what's going on in the banking sector, some considering that maybe they should have held rates where they were, but really kind of adding some credence to the fact that the rates market has repriced rates and maybe there's one more hike, but they're pretty much done. So the markets were already expecting that, anticipating that. We've seen that in terms of the tech rotation that we've seen. We've seen that just in markets being resilient and kind of responding well to the dovish rates repricing. So that's why we didn't really get much continuation of the rally, I would say, because to some extent that news was already priced into the market. Europe did manage to stay green. China, though, was weaker as Alibaba sold off around 5% on news that SoftBank are selling its stake there. And then most commodities were firm again, but Nat Gas failed to hold the gains from the previous day, so giving back 6%. But we did see decent gains in the likes of oil, silver, copper, things like that. Looking at vols, mixed picture. S&P vol and FXI, so China vol, were slightly better bid. Everything else a little bit softer in terms of equities. Commodity vols were also generally lower, but nothing too dramatic in terms of the size of the vol moves. The general trend in macro cross-asset volatility coming down is still intact. So it wasn't just a seasonal thing. Vol is just coming lower and it's staying lower. And focus is now going to shift towards earnings. And when that happens, you do tend to see index vol not really doing much, as people are more interested in single stock vol to play the stories of the various names. Now, if you do start to get a kind of common theme across earnings, like everyone missing and giving poor guidance, then that will turn into a more macro story. But if you're getting a mixed picture of some stocks go up, some stocks go down, like you normally get in earnings, that dispersion, then index vol doesn't need to go crazy bid straight away through earnings. You can see on the carry side of things, positive across the board still. CPI didn't really produce any outsized moves there. So that is all still staying green. If the carry metrics stay this green, expect more vol sellers to be attracted to this, to earn some carry, and that will take implied vols even lower. Earnings are going to be important, again, to determine if vol is going to return or macro vol is going to return. So that's really the thing to be keeping an eye on. In terms of skew, we did see a slight uptick in most equity put skew. It seems to be fairly stable at this area that we've been flagging in terms of percentiles, around that 30% percentile range. A bid also coming back to some precious metals put skew, which is not really puts going bid, it's just more calls getting sold harder than puts getting sold. So vol's coming down, but call vol coming down a bit more as we, not really smashing through the upside on gold, and we're losing a little bit of that positive momentum, that strong positive momentum on the rally, even as we approach those kind of all-time highs. And then lastly, copper skew lower, flipping towards call premium as we bounce off that $4 level again, which is held now for the third time or so. Okay, shifting gears to the charts. That I've noticed, S&P did obviously have staged a strong recovery since the middle of March, when the banking crisis was obviously front and center. Now, with large US bank earnings kicking off on Friday, we've seen hedge funds getting shorter S&P futures, and sentiment is pretty bearish, especially on the banks, which is understandable. But just to be aware that the setup is there for a squeeze, given how bearish sentiment is in the banks, and the fact that we have seen shorts being increased by that cohort of hedge fund investors taking those S&P futures net short positions to quite extreme levels. So, we do sympathize with the view that markets do look toppy here, given the uncertainty around earnings, the economy, inflation, policy rates, but we do see risk of an upside pain trade still, right? So, what the market is like, it loves to inflict as much pain as possible. And if everyone's short and bearish, in terms of discretionary people, investors, then there is still some pain potentially on the upside. Now, looking at volatility, short-term realized volatility is absolutely collapsed. So, 5-day realized on S&P is down to around 4%, right, which is unbelievably low. And that's due to a few factors, seasonal factors, with Easter, a rotation from cyclical sectors to defensives has meant that the headline index hasn't been moving as much, but you've had movement sort of under the hood. And then option dealers obviously getting caught long gamma as we kind of grind up into levels where we're getting closer to expiry, and dealers are clearly long options around here. Okay, so we've got April OPEX due next Friday. So the evidence of realized volatility is showing us that the dealers must be long up here. Okay, I don't like to just make the flat assumption of dealers are always long when we rally and they're always short when we sell off. We want to see that confirmed by the realized, and that is definitely being confirmed by the realized right now. So it suggests that as we go into April OPEX next week, it's going to be hard for the market to do anything. If the market can't move now, unless we get a real shocker out of the bank earnings, the market's going to struggle to do much. S&P, that is, going to struggle to do too much. So we're probably going to get an unclenching of the market after that Friday OPEX next Friday, where you'll get a large amount of gamma rolling off, and that will then mean the market's free to move again, right? We see that happening quite a lot in expiries when dealers get caught long. The market just struggles to move because everyone's just hedging that frantically to try and make back that theta bill. Markets can't go anywhere. Definitely feels like that's what the market environment is right now. But then once all that gamma expires, the market's got a bit more freedom for movement. And with so many shorts around, I wouldn't be surprised if the move, when it does come, is more to the upside, right? Because it may be that that's the pain trade. It may be that higher, 100 points higher, because options are so cheap now, it's easy for some clients to go and buy those options now to get a bit of upside hedge on, and dealers might find themselves a bit shorter up there. So that's something to be aware of. And that's not something that's being kind of said by most of those gamma models on the street. Okay. But that reality of a recession setting in later this year that then may take stocks down, I think we might have to get a squeeze first, given the way sentiment is right now. I have been reducing long exposures though, just as the market's been coming up, and we have been leaning long, but I am wary of getting short just yet. So, I don't think the setup's there to make that much money on the short side right now. So whilst it's prudent to bank some of your longs, given where the market is and we're going into earnings with a load of uncertainty, I just wouldn't get overly excited about going short, and be a bit patient on the short side if you are trying to lean that way. Okay, now reviewing a few of the trades that we've had on for a few weeks. So first, let's look at FCX. This is our copper proxy, Freeport-McMoRan. It's kind of the most liquid asset we see to get a decent exposure to what copper's doing. So a few weeks ago in our daily note, we did put out a call ladder idea where you could buy this April 42.45 call ladder for around 35 cents. So in the last few weeks, the stock has bounced pretty nicely off around 38 to 41, so just under 10%. And that's vols got hit pretty hard. So implied vols have lost about 7 or 8 vol points in the front end. And that is your perfect combination for a call ladder structure. When spot goes up, vol gets crushed through the passage of time as well. You're earning time decay. So the price has done pretty well. The ladder price has gone from 35 cents to 85 cents. So that's 142% gain on the premium spent. That's not really the right way to look at the percentage gain though. You should, when you're doing option structures that are open-ended like this, you're better off looking at the return on margin used. So when you do a call ladder like that, you are going to have to post some margin. So when we look at it like that, I'm seeing the return closer to 10% of margin used, which is still a good return for a 3-week trade if you're making 10% on your money. But it just puts that into context, right? Rather than looking at the 142% and thinking you're a hero, right? Because this doesn't make sense. Now, with only 9 days remaining on the trade, we need to evaluate the merits of keeping the position or taking profit. Now, looking at copper, I'm seeing copper has been underperforming silver and gold, right? Which have been doing quite well. So there may be a bit of a catch-up trade in copper, given that we've held that $4 support level once again, and we are bouncing now. Okay, So that makes me slightly more optimistic on copper, and then that will feed through to FCX. So I do see scope for upside. Also, if we look at the trade on our good old option strat visualization thing here, you can see the dotted line tells me where we are right now, and these other the dotted line, the vertical dotted line, that is, right, where the stock's at about 41. So through the passage of time, this thing is making more money. So it means we are earning theta right now. So when you're earning theta on a trade and you are slightly bullish and the trade does well if the stock goes up, you kind of don't feel too much pressure to do anything, right? So definitely happy to hold on to this trade for now, given that it's theta positive, given that it's slightly delta positive as well, and we think the stock has got scope to go a bit higher. If we then look at another trade that we actually talked about the day before on the 22nd of March, it was the USO call condor. USO was obviously the oil ETF where that got pretty beaten up in March. So 22nd of May, we were trading around here, around 61. We were trying to set up a bullish trade. We were looking at oil. Oil vol was pretty pumped at the time. So didn't really want to buy outright calls. So call ladder structures obviously would have worked as well, but we didn't like the ladder because we weren't comfortable selling the naked upside tail in oil. So we did a condor instead because we knew that geopolitical headlines could move oil and it could gap. And that's exactly what happened, right? We've got this big gap from 66 to 70 on the back of the production cut that we got on from OPEC. These are the type of risks that I didn't want to be exposed to. And that's why I did the condor as opposed to the call ladder. Okay. Anyway, that trade has still done okay. It's doubled its premium. So we paid 60 cents for it. It's worth roughly double that right now. But looking at the chart, because we've popped above this kind of 71.2 area, it does concern me that we may well be breaking out in oil and it might want to go through that 74 level and then we go back to zero P&L on the trade, right? So we would give all our money back. So we can see here, we're sitting here right now. If the stock, if USO does trade quickly up to 74, 75, most of our P&L will go away. And we are still earning theta though. So that's one saving grace. But the point is, because of the slope of this line, you can see we are short delta now in oil. I do think oil is a bit stretched, so it might pull back. So I'll be looking for it to pull back to 71, test that level, see what happens there. But I'm not going to be stubborn with this trade. So if oil doesn't pull back in the next 2 or 3 days, I'm probably not going to just sit on this trade until next Friday and take the binary risk that all my P&L disappears in the last couple of days, basically, right? So that's the way I would look at it. Probably slightly less relaxed on this trade than we are on the FCX trade, and monitoring this one, thinking we want to probably close it if oil doesn't show any signs of pulling back in the next day or two, basically. All right, that's it for today's. No fresh trade ideas, but it's always good sometimes to look back at some old trades, look how they did, think about the logic, why you put them on, and how you, if you need to risk manage them or restructure them, think about how you evaluate those things. Okay, thanks for listening. I'll catch you all tomorrow. Cheers.